So today we're going to talk about how to buy your first small multifamily apartment building, and we're going to go into some details, so hang with us here. I think you're going to really enjoy this, and my goal here is to educate you as much as possible. So the first thing we're going to talk about is why multifamily to begin with, okay? I mean, you got to have a reason to do this, and you know, when I do my goal setting workshop, it's the why that's the most important piece. So let's talk about the why. The first one is income. That's why the name of my podcast is Lifetime Cash Flow, because that's what you're building when you're buying apartment complexes, right? You're developing passive income, and there's nothing better than passive income. The next thing is you're able to force appreciation. Now let me talk about that for a moment. In residential multifamily, which is a duplex, triplex, fourplex, the only appreciation you're going to get is based on comparable sales. But in commercial multifamily, which is 5 units plus, you're able to force the appreciation because any increase to the rents is an exponential increase to the value. I mean, it's like 17 to 1. For like $1 gives you $17 in value, or even $20 in value, depending upon what geographic area you're in. So that's one of the biggest reasons we love it, because you're able to instantly increase the value. The next thing is the tax benefits. There's a reason that 90% of the millionaires in this country use real estate or own real estate to build that wealth or to protect that wealth. It's because of the incredible tax benefits with buying apartment buildings. They're unbelievable. For example, cost segregation. You know, normally when you own an investment property, you can depreciate. Well, you're able to do an accelerated depreciation, which is called cost segregation, which is just unbelievable. You're able to get really good financing on your multifamily, okay? Because, you know, it's such a stable asset class. It's such a resilient asset class. And what I mean by asset class, so there's office is an asset class, retail is an asset class, self-storage. But a multifamily is such a resilient asset class. In fact, let me tell you something. Back after the crash of 2008, within 3 years, the rents were above where they were in 2006. That's how fast it recovered. Okay, so you're able to get really good financing on these properties. And like I just said, they're recession resistant as well. By the way, my name is Rod Khleif, and I've owned over 2,000 houses. I've owned thousands of apartment units. In 2008, I lost $50 million. And the reason I lost it is because I was in mostly single family houses, and it was the single family that pulled me down. I had some apartment complexes. They did just fine in the crash, which is the reason that I started my podcast, was to give people that message that if you're going to buy and hold real estate, for God's sakes, do apartments, don't do houses, right? So there, and again, my multifamily, it pulled back a little bit, but it would have easily survived if I hadn't combined them. So what happened was I cross-collateralized my packages of houses with my apartment complexes to save, you know, some interest rate. And so the whole thing fell because the houses pulled my apartments down. But if I hadn't done that, I'd still have those apartment buildings. All right, so they're recession resistant. They're great for resale. There's a huge demand for apartment buildings. So you know, when you're ready to sell, there's no issue at all. And then lastly, you can outsource the management, okay? And so you can hire a third-party property management company to deal with the toilets and the tenants and all that stuff. Yes, you have to manage them, you know, but that's a weekly phone call, okay? You know, once the property's stabilized. We're going to talk about what that means in a minute, but that's a huge benefit to multifamily, is that you can outsource that property management. The other thing is, you know, if you've got a house and it's vacant, you're 100% vacant. Okay, if you've got multi-units and you've got 1 or 2 units vacant, it's called a dispersion of vacancy risk. You don't really have, you know, you can survive, you know, vacancy on your multifamily properties because it's not just 1 unit like a house. So you've got that as well. Now let's talk about some of the risks of multifamily. Okay, because there are risks. With anything, there are risks. Okay, the first thing is the market risk. So if you're in a market and the economic conditions change, for example, let's say, you know, like the oil crisis back in the day caused a real huge impact in Texas and Dallas and Houston, and there was a lot of economic unrest when that happened. Or, you know, the S&L crisis. I'm old, so I remember all this stuff. That was back in the 80s. The savings and loan crisis caused economic conditions to happen. So those risks are still there, but they're fairly minimal, okay? So that's market risks. Then you've also got operational risk, okay? Let's say, you know, if you dabble, you can't dabble in this or any business. You have to learn it so that you don't make mistakes. For example, a newbie mistake would be to expect the cash flow from a property to cover your renovation costs. You don't do that. You bring that money to do the renovations to the deal, okay? You raise that money or you bring it to the deal so that you don't have to expect, rely on the cash flow. Or let's say that you don't accurately estimate the repairs and they end up being more than you anticipated, okay? So that would be operational risk, and that's usually with newbies, okay? Seasoned operators, that's less of an issue. So that's operational risk. Then you've got acts of God. Stuff happens. I will tell you, I have a 101 unit asset up in Beaver Creek, Ohio, 101 units. It got hit by a tornado. Thank God nobody got killed, no children got hurt, but the whole complex was effectively destroyed, had to be rebuilt. But let me tell you the good news on that one, okay? It's 101 units. We are getting a $650 rent bump, okay? And let me just do the math in my head. A $500 rent bump once over those 101 units is a $10 million instant increase in value. That's why we like this business, my friends, okay? But you have acts of God. Stuff happens, but that's what you have insurance for. Hurricanes and fires and things like that, they happen. God forbid no one gets hurt, but they do happen. And again, that's why you have insurance. Then there's pro forma risk, okay? Now, a pro forma is your estimate of how you think the property is going to perform when you buy it. And I will tell you, there's some aggressive operators out there right now that are a little over the top with their estimates of what's going to happen with rents, their rent increases that they plug into that pro forma, because when you're doing an evaluation of how you think the property is going to perform in the future, you're going to have the rents go up, you're going to have expenses creep up, things like that. And there are some operators that are a little too aggressive with that. And that's a pro forma risk. And that's why, I teach my students to be conservative. There's no reason to be aggressive. Be conservative. It's better to be safe than sorry. And so that's the last risk that I listed here, pro forma risk. All right, so let's talk about how you get started, huh? So the first thing you've got to do is you've really got to establish some investment criteria. And the first piece of that is choosing a market, okay? So here's what we look for in a market. We look for population growth. We want several things to be growing. We want population to be growing, we want income to be growing, and we want jobs to be growing. Now, what do you think is the most important here? I'm going to tell you right now, it's jobs. Jobs are absolutely the most important component of owning multifamily properties, of owning apartment complexes. Now, the other thing we want to see is we want to see employment diversity. Let me tell you, when I had those houses, though, I had 800 houses here in Florida, 2 hours north of me, 2 hours south of me, and everywhere in between. But what killed me was the fact that most of my residents were contractors, plumbers, electricians, drywallers, painters, roofers, HVAC people, and they got killed in 2008 and 9. There was no work. That was like the final straw that caused me to lose what I lost. Was I didn't pay attention to that with my houses. I didn't think that was going to be an issue, but it was. So now I pay very close attention to employment diversity. In fact, we just bought a 280 unit complex up in Cincinnati, and I literally went on their rent rolls and I looked at every single resident where they worked. And then what I did was I kind of gauged that employment to its ability to be resistant through COVID, for example, or any recession, period. And so I literally, line by line, looked at where they worked. If they worked at restaurants, okay, check, that's not a good thing. If they, like somewhere at Delta Airlines, and Delta got killed because of the COVID thing. So I looked at where every single one of them worked, and then made a decision. And it worked out to be the right decision. That place has been practically 100% occupied since we bought it. But the point is, I look for that employment diversity. And the other thing I mean by diversity is I don't want any one-horse towns. If there's one major employer, that is a huge risk, okay? Because if that horse gets sick, or that horse leaves, you're in some deep, you know what. So, and that also goes for military bases. If there's a city that's heavily reliant on a military base, I pass, even if it's a great looking deal, because again, sometimes these bases close, right? Very important. But I want to see many different industries. When I'm talking about employment diversity, I want to see all sorts of different industries, so that that you've got that balanced risk, right? I also want to see a good transportation network, right? I want to make sure people can get around. I don't know if you've ever been to LA, but it's a train wreck. I mean, it takes you an hour to go what takes 15 minutes in most towns. Okay, so I want to see good transportation network. I want to see dining, shopping, and entertainment. What can people do that they might enjoy, right? So I want to know about that. I want to see dining, shopping, and entertainment things. I want to see a history of rent rates going up, okay? Basically, that's a strong demand and ideally limited supply. Like that Cincinnati asset, it's pretty much landlocked because there's really nowhere to build new complexes there. So we like that because it's going to minimize supply. We've also got a property in Lexington, Kentucky. And they've got this rule in Lexington that you can't eliminate farms because they're known for their horses and stuff. And so it's a limited supply, and we love to see that. I also want to see rent versus buy dynamics that are favorable for renting. Because if you can buy for about the same price that you can rent, that's a problem, right? People are going to buy. So I want to see where the property values are high enough that it's attractive to rent, okay? That's why if you see higher median home prices, they're going to drive people towards renting, and that's what we want. Now, I will tell you, we are becoming a renter nation. I'm going to tell you that. Millennials don't want to get locked down, and even aging baby boomers. They're selling their houses and using that money to live and renting a much smaller place. They don't need a big house. They're empty nesters. They've been empty nesters for decades. So how do you get information on a particular area? Well, there are multiple places you can get the information you need. And I want to give you those websites. You might take some notes here, okay? So where do you collect the data? Here's multiple websites you can use. City-data.com is a great one. We use that one a lot. City-data.com. Bestplaces.net, another great one. Okay? Census.gov, that's a government site. Another one, BLS.gov, another government site. Rent Cafe is a good one to check rents. This is another one we use very heavily, datausa.io. So these are websites where you can get demographical information to see if those things I was talking about, like income, jobs, and population, are growing. You can even see where the crime is in an area. And I don't want you to be intimidated by this. Have fun with it, because it just immerse yourself in it. Play with it. It's really not complicated once you get into it and play around in there. So those are the websites you can get information. Then you've got to pick a property, right? So you've got to have some investment criteria. Now, I'm sorry about this analogy, but if someone will send me a better one, I'll use it. You don't want to shoot with a shotgun, you want to shoot with a rifle, okay? You want honed in, focused criteria. Because if you go to a broker or you go to an investor, potential partner, and say, I'm just looking for a great deal, they're not going to take you seriously. You want to tell them you're looking for an A or B asset in a B and C area in this submarket with a cash-on-cash return of, say, 10%. I mean, I'm just throwing stuff out here, but the point is you want to have some detail in your description of what you're looking for. So you've got to come up with some investment criteria. So what's included in investment criteria? Of course, the type of property. And are you going to go with the residential multifamily, which is the duplex, triplex, or fourplex, quadplex? Up in Northeast, they call them 2-family, 3-family, 4-family. Are you going to go with that? Again, I told you there are some advantages to that. I will say there are advantages to the smaller multifamily. The advantages are that the financing is fantastic. And if you're going to live in there, it's very high leverage as well. You can get a 97% loan, which you can't do in the commercial multifamily. But you got to live in it for that. And if you're a vet, you can get 100% financing on one of these, which is fantastic, okay? But the negative, again, is the fact that you are governed by the comparable sales. You're not going to be able to ramp the value here very much. Or some of the other types of property are garden style properties. You've seen those. A walk up where you walk up some stairs. Those are very common in New York. There's a multi-story that have elevators, obviously. There's the townhouse style. I love townhouse style. But anything 5 units or more is considered commercial multifamily, okay? Now, there's also different asset classes, okay? The A class obviously is the nicest. It's the newest, has the most amenities. They're the brand new stuff that's being built. And then there's B and C, and there's quite a bit of subjectivity with B and C, okay? Depends on the number of amenities, how functional the property, the units are, for example, are the ceilings low, are the windows big, are the rooms too small? If they are, that's called functional obsolescence. And that kind of helps you determine if it's a Class or B. The age also as well helps you determine if it's a Class B or C property. You've also got A, B, C, and D areas as well, right? Stay out of the D areas for God's sakes, okay? Ask me how I know. And by the way, I did these live events, and one of my students gave me a shirt that says, "Ask me how I know," because I've made every mistake you can possibly make. So learn from my mistakes. I don't make them anymore, but I did. And so we actually now have these t-shirts that we sell at my live events that say, "Ask me how I know." And by the way, you know, we all know what happened with the live events. I was supposed to have 800 people in Orlando back in May, and you know, we know what happened with that. So now I do live stream, and we're actually shooting at my studio here at my compound here in Florida, and I've had thousands of people come to my live stream boot camps, and I'll tell you, I'm going to have one here in short order, and if you want to join me, I'll tell you how you can do that later. You can come for like $97, and I don't sell anything at these events. They're 18-hour events. I'm just drinking through a fire hose. I'm going to tell you, we go in great detail into all of this, but it's $97 and I don't sell anything, so it's kind of a duh. You know what I'm saying? But I'll tell you how to do that at the end of this thing. So you also want to determine what size units you're going to go after, right? And so you might go 10 units or smaller. You might go 10 to 20, 20 to 50, 50 plus. You know, so there's lots of decisions that you're going to want to make based on, you know, how comfortable you are, based on that courage muscle you have. I see so many people, they'll start with a duplex, and they'll do a 10 unit, and then it's 100. A lot of, you know, and I interview people on my podcast, and that's a very common progression. Nothing wrong with that. Some people go right to 100. But you know, it's interesting. I always ask the question of the really seasoned operators. I ask them, you know, if you could go back and tell your 20, you know, these are guys with thousands of doors and women with thousands of doors. And I ask this question by design, and that is, if you could go back and tell your 20-year-old self something, what might you do differently? And you want to know what I hear 90% of the time? Go bigger, faster. Okay, so that's a clue, right? All right. So you got to decide what price range you're going to go after. You know, really based on where you think, you know, what you think you'll be able to get financed. Now, I'm going to tell you, the beautiful thing about commercial multifamily is they're not looking at you. They're looking, well, they're going to look at you, but not to the degree like with the residential multifamily. They're going to look at the property's ability to service the debt. Okay, so they're gonna want to know that the property can pay the mortgage payment. And I'm going to talk about something they look at, a ratio they look at here in just a minute. But so what price range? You're going to go under $1 million, $1 million to $5 million, 5 to 10, 10 plus. You know, we just closed on a $35 million property 2 days ago in Dallas, 269 doors. You know, you got to decide what level of renovations are you willing to deal with, okay? Do you have any sort of a, you know, construction background or someone on the team that's got that, or a contractor that you can rely on? You know, you're going to go with minor cosmetic repairs, or you're going to do, you know, major, deal with major. Minor would be probably anything from 2 to 6,000. Over 6,000 would be more major. You know, what sort of an occupancy are you going to look for? Let's talk about that for a second. So with occupancy, if the property is 90% occupied, it's considered stabilized, okay? And that's important when you're going after the financing. I'll talk about that in a minute. But under 90% is not stabilized, and that will determine what sort of debt you can get, okay? You know, if it's fully leased, you know, if it's then the other thing you want to look at is if there's a vacancy in the market. For example, we bought an asset in Louisiana, and it was 70% occupied, but the market was 95% occupied. Okay, property 70%, market 95% occupied. That's what we call a clue, my friends. And so, you know, that's going to be a real home run for us. Okay, and then, you know, is the property distressed? And if so, you know, let's say, you know, the owner's struggling for some reason. Why? Okay, they run out of money, poor management. What's the issue there? Or is it the property? Units are too small, wrong bedroom count for the demographic in that area. What's going on with that property? So you got to dig into that to figure that out. All right? So now let's talk about how to find a property, right? You with me? You still with me? Okay, so we're going to talk about how to find a property. Now, obviously the internet, you guys have such an incredible resource with the internet. I mean, when I got into the business, if you wanted to know what was for sale, you got this book in the mail, okay? And then if you wanted to go see a property, you had to take your happy butt in the car or on a plane and go see it. Now you can go on the internet and you can drive down the street on Google Earth. It's just incredible what you have available to you now, right? So you go on the internet, check it out. There's all sorts of websites that you can go to. There's loopnet.com. That's the largest largest commercial real estate. Again, that's LoopNet, just like it sounds, loopnet.com. And see what's for sale there. All of the big brokerage houses have their own websites. Grubb & Ellis, CBRE, there's Marcus and Millichap. They all have their own websites that you can go there as well. You can make cold calls to find deals. How do you think brokers get deals? They call owners. I've got students that kill it making cold calls. You can do mailing campaigns. I've got students that have been killing it with mailing campaigns. I'm really proud of this. You know, I've got a mentorship program. It's called my Warrior Mentorship Program, and I've only been teaching about 3.5 years, and they're somewhere now between 40 and 50,000 units owned. Okay, it's just mind blowing to me. Anyway, and some very successfully writing letter campaigns, cold calling. Of course, working with a broker. That's kind of a no-brainer because the brokers know what's available for sale in many cases, and so, you know, working with a broker is very, very positive. You can drive the market. You know, it's craziest thing. People drive for dollars with single family, but they don't do it with multifamily. But the ones that do are very successful. Now, let me just say this to you. Anytime you're willing to do what other people aren't willing to do, you will be a success. It's just the way success is inevitable. I remember in Denver, when I really got rolling is when I started knocking on the doors of people in foreclosure and saying, hey, if you're interested in selling or can I help you in any way? About 500 houses there. All right, doing what other people aren't willing to do, right? All right, so now let's talk about how to screen a property, okay? And so obviously you're going to be looking at the purchase price. Where is it at? You're going to look at what does the property need for repairs, okay? What capital improvements are needed. You know, can we raise the rents right out of the gate? I gave you that example for that Beaver Creek, Ohio property, you know, because that exponential increase in value based on a smaller increase in rents. You know, I like to see at least a 10 to 15% minimum ability to increase the rents, okay? Then what I do is I look at my cash-on-cash return. So what is that? Let me tell you what that is. Cash-on-cash return. Let's say that you're buying a property, and I'm just going to use round numbers here, okay? Let's say you're buying a property for $1 million, and you have to come $100,000 out of pocket to close, okay? So that includes your down payment, your closing costs. Now, those aren't real numbers. In fact, you'd need more than that, but I just want to use this for an example. So you've got $100,000 out of pocket to buy that property. That includes closing costs, down payment, maybe even renovation costs that you've lumped in. Now, the cash-on-cash return is how much money you make on that $100,000 out of profit every year. So if you get $10,000 your first year, that's a 10% cash-on-cash return. So you've got to calculate, you've got to figure that out, right? The beautiful thing about this business is that it's empirical. It's primarily numbers. If you get everything else right, it's pretty hard to make a mistake if you ask all the right questions. In fact, let me give you a free resource right now. I'm going to write it up here. If I've got a book that I wrote that's got just about every due diligence question you'd ever want to ask, and I'm going to talk about due diligence in a minute, but before I forget, I just don't want to forget to give this to you. If you text my name, Rod, to 72345, okay, text Rod to 72345, you'll get that book. And it's not some sales pitch, it's just a total value. It's like 70 pages of every question you could think of. Where were we? Okay, then there's the internal rate of return, okay? So when you're talking to investors to put money into your deals, they're going to be interested in what your cash-on-cash return is, and they're going to be interested in what your IRR are, your internal rate of return. Now, what's the internal rate of return? It is the total return from the property. It's going to include cash flow. It's going to include appreciation. It's going to include principal reduction on your debt, because you know you're making mortgage payments. The principal reduction is going to go down. It's basically going to include everything is included in the IRR. And so typically what an operator like myself will do is we'll do like a 5-year window. We'll assume what the property's gone up, what its cash flowed, what's the principal's gone down, and then we come up with that internal rate of return. Okay, and then there's something called an equity multiple. Let's say you put $100,000 in equity in that, like that previous example. By the way, in the single family space, equity is determined by the value of a property and the debt, and the difference between the two is the equity. In single family, like if you've got a $100,000 house and you owe $50 on it, you've got $50,000 in equity. Well, it's a little different terminology in commercial real estate like we're talking about here. The equity is the amount of money out of pocket put into the deal. You've got the equity and the debt when you're talking about commercial property. The debt obviously is the loan. The equity is the money that's out of pocket, like that $100,000 example I just gave you. Now, an equity multiple is, let's say, once you calculate it in 5 years, that you and your investors get back $200,000. That's a 2% equity multiple. Does that make sense? You've doubled your money. All right. And then, are there ways to save money on costs? Very important, okay? Are there ways to save money on costs? Is the occupant, like expenses, can you put in LED lighting or water-saving devices, or maybe they're paying too much for the management, so you want to look at that as well. Is the occupancy stabilized, or is it fluctuating a lot? And if it is, if you're having a lot of turnover, why? Is it poor management, or is it they don't like the units? Is there something wrong with the property? It's usually poor management, but you want to dig into that, right? Now, when you're evaluating a property, are you going to use a third-party property manager, or are you going to self-manage? Okay, and I think it's not a bad idea to know how to manage, but I would highly recommend, if at all possible, that you hire a management company, especially if you've never done it, to see how they do it. Because there's a lot of failure in people that don't know how to manage, okay? And so, I'd recommend that you buy a property that you can hire a third-party property manager, if nothing else, just so you have a life, okay? But if you want to ultimately self-manage, then I would still hire one first to learn the business, okay? So what's the next thing here? All right, you're going to make an offer, all right? So there's something called a letter of intent, LOI, letter of intent. Now, in the commercial real estate game, if let's say you've done some flipping, or you've got some single family houses, and maybe you've written your own contracts, you are not ever, now hear me now, you are never, ever, ever going to write your own contract in the commercial world, okay? I've written thousands, I would never consider it, okay? So, but you're always going to use an attorney, I guess is my point. You're always going to use an attorney. Here you go, I have it on here. Always use an attorney, because there'll be things you miss otherwise. Now, are attorneys free? No, they're not. And so, if you're going to write a contract every time you make an offer on a property, you're going to spend a lot of money. So we use what's called a letter of intent. It's like a 2 or 3 page document that spells out the most important pieces of the deal, like how much you're offering them, what are the timelines, how long are you going to have for due diligence, how are you going to pay, financing or seller financing or cash, any other specific nuances, if you're asking for a credit for some repairs or something, anything, who's going to prepare the contract, anything like that will be spelled out in that LOI. What that does is it starts the conversation. And once you've agreed on the main deal points, then you take it to an attorney and spend the money. Okay, does that make sense? So it's much better, whenever possible, to start with an LOI, because it doesn't cost anything, right? You just put in the main deal points, seller says, yeah, that sounds okay, or you go back and forth a little bit, then you take it to a PSA, it's called, by the way. You want to learn the acronyms here. Again, like you saw the COC, cash on cash, IRR, internal rate of return, PSA. Not public service announcement, purchase and sale agreement, okay? All right, always an attorney. We talked about that. All right. Now, here's some clauses that you will see in a PSA. Now, I hesitated to put these in because I don't want you to try to write your own, right? We talked about this. But I'm going to still give you a little education here. So I'll tell you what's very often in a contract. You go, who's buying it, right? Now, in the commercial world, the name on the contract rarely, if ever, is the one that ends up owning the property. You'll make the purchaser assignable, because typically what you'll do is you'll set up a property-specific LLC. Okay, an LLC just for that asset, just for that property. So you're going to assign from your name or your branding company name into the property-specific LLC. Obviously the contract will have earnest money, how much earnest money you're putting up. Now, the thing with earnest money in the commercial real estate world is once it's non-refundable, it's called hard. And typically, it won't go hard until after you've done your due diligence. You've checked the place out. You've had it inspected, which we're going to talk about in a minute. But once it's hard, it's non-refundable, okay? So it's going to have your inspection and due diligence provisions, how much time you have. your ability to inspect, and you're going to inspect several things we'll talk about in a minute. It'll usually have an as-is clause. After your inspection, it's going to be as-is. It's not like the single-family space where you can have a home inspection and make them fix the roof or whatever. In the multifamily, typically, you're going to inspect it, and it'll be as-is after that. It's going to talk about title commitment. Who's paying for it? There'll be seller's representations. If there's anything going on with the property, they will disclose it. And if they don't disclose it, then you've got an argument for what's called retrading or renegotiating or backing out. Okay? It'll talk about what happens with the property, the operations during the contract period. Okay? Who's going to manage it? What sorts of things could happen? If something happens with the property, fire or act of God, what happens? It'll talk about that. Okay? And there'll be termination rights, how a contract can be terminated, either by the buyer or by the seller. It'll speak to that in great detail, very important. And of course the price, okay? So that's what will be on the PSA or the contract. Now, when the contract is signed, then you've got to make some things happen. You've got to arrange the financing. Now, you'll be doing this actually simultaneously. You'll probably have had a lender look at the deal before you even put it under contract, so you know what financing is available, but then you've got to get rocking on that, right? Then you're going to have what's called a capital stack. Now, what a capital stack is debt and equity. Remember we talked about how equity is the amount of money out of pocket, and then there's debt. So let's say in that example that I showed you, let's say it's $1 million purchase price, right? And we talked about $100,000 down. Now again, you're not going to get a $1 million property for $100,000 down. I'm just using this for simplicity. Okay? Then you've got a $900,000 mortgage in this case, right? So that's the capital stack right here. This is the capital stack. And that's just so you know the terminology. I want you to know the nomenclature. Okay, that's how it works. All right. So the beautiful thing about multifamily is the availability of debt. And I'm going to give you some of the places you can borrow money for multifamily. Okay? There's Fannie Mae and Freddie Mac. These are two governmental agencies. And with these loans, you have what's called non-recourse. Okay, if they foreclose, all they're going to take is the property. They won't come after you personally. That's Fannie and Freddie. You've got FHA as well, which is now becoming very popular for larger multifamily. And they have non-recourse as well. You've got private lenders, just like you do with single family. You've got banks, and I would recommend you typically start with banks to see if they've got anything available, unless it's a larger deal. You've got pension funds. You've got bridge lenders. Now, what bridge lenders are is if you've got a property that's not stabilized. By the way, to do Fannie and Freddie Mac, you have to be 90% occupied for 90 days. Okay, 90 for 90 it's called. 90% occupied, physically occupied for 90 days. Then you're able to get Freddie and Fannie debt, which is, and this is called stabilized. Now, if it's not stabilized, what most operators will do is they'll get what's called a bridge loan. And it's just like it sounds. It's a loan that's going to bridge you so that you get the property stabilized and then you refinance into this really good Fannie Freddie non-recourse debt, okay? So that's a bridge loan. Now, I got to tell you, bridge lenders are like the wild freaking west, okay? I don't know if you've ever heard of hard money lenders in the single family space. That's really what bridge lenders are in the commercial multifamily space. You want to be very careful with them. You want to make sure you get highly recommended and you work with someone that knows what they're doing if you do bridge debt, because again, it's the wild, wild west. Okay, so let's talk about loan qualification. Now, in the single family space, in the residential space, duplex, triplex, fourplex, you'll have very often a 30-year amortization, and there's no balloon, okay? No balloon payment. Now, in the commercial multifamily space, you might have, I don't know why I put 30,000 in there. You'll have a 30-year amortization, sorry. But in the commercial multifamily space, you'll have a 5, 7, 10, or maybe an outside chance, a 12-year balloon. It's called the term of the loan, okay? You don't really use the term balloon in the commercial multifamily space. You use it in the residential space. But that's the term. So you'll have a 30-year amortization in the commercial world, or 20 or 30, okay? And then you'll have the term of the loan. It'll term out in 5, 7, 10 years. Now let me say this to you, word of caution. I believe we're going to probably have a correction at some point. Real estate goes up and down. It's like the seasons of life, okay? That's the way it works. Not something to fear. A correction actually is an incredible opportunity because with crisis comes opportunity. But the worst thing in the world would be to be at the bottom here when with a 5-year balloon coming up. Let's say your 5-year hits here and you can't refinance because the value's gone down. Okay, very important. So I will not. I tell all my students at least 7 years right now, if not 10 years on the term on your debt. Okay, just a little advice there. You'll have what's called a max loan to value, LTV, loan to value. And so in the commercial world right now, it's somewhere between 70 to 80%. Okay? You have $1 million property, you'll be able to borrow $700,000 or $800,000. Okay? So it just depends on the type of asset, where it's located, its historical performance, things like that. So that's the loan to value. Okay, DSCR. DSCR is debt service coverage ratio. Okay, debt service. I'm going to explain what this is in just a second. Coverage, and this is what the bank looks at. Remember I talked about the property's ability to service the debt? That's the debt service coverage ratio. So let me explain this to you. In commercial real estate, you have what's called the net operating income. It's the net income. So you've got the property. The income on the property from all sources, okay? All income, I mean, that could be rents, laundry, everything else. You've got property expenses. Now, this does not include debt, but every other expense on the property, taxes, maintenance, everything else, the difference is the NOI, net operating income, okay? Now, again, I told you any increase to that net income is an exponential increase it's about 17 to 20 to 1. 17 to 20 to 1 increase in value, okay? Now, the debt service coverage ratio is the difference between the NOI, net income, and the mortgage payments on an annual basis. So let me give you an example. Let's say you've got a mortgage for the year, it's $100,000. That's what your payments add up to over the year. Maybe it's $8,000 a month, for example, but it's $100,000 a year, annualized. Let's say that your net income is $125,000 a year, okay? So let's say this is $125,000 and the annual debt is $100K, and this is $125K. You with me? Okay, that's a 1.25% debt service coverage ratio. Do you get it? $100,000 in debt payments for the year, $125,000 in net income for the year, 1.25% debt service coverage ratio. By the way, that happens to be the minimum that most banks or lenders will take. I try to get up around 1.5, 1.6 before I'll buy a place. But anyway, now we talked about non-recourse. Recourse debt is they come after you personally, okay? And that's with banks and things like that. You'll have recourse debt. So anyway, typically you would start with banks and credit unions to try to get the financing, or some Fannie or Freddie lender. And if you're unable to qualify, then you look at other options like maybe bridge debt or things like that. But we also need to talk about equity. Okay, so again, equity is the cash from the borrower or what you raise for the deal, right? And it can come from friends or family. It can come from you. It can come from friends or family. It comes from investors. It can come from partners, okay? And so, you know, you should always be developing relationships with potential investors, potential partners. If they hold still long enough, they should know what it is you're doing. Yeah, we're going to be buying multifamily properties. You know, we're looking for great deals. By the way, if you come to my boot camp, we give you a sample deal package that you can use to present to an investor. Say, hey, you know, this is what we're looking for. If we find a deal like this, do you want to hear from us? So that's, you know, one of the things we give there. But anyway, so, you know, you should be talking to investors all the time. So now, the last piece of this really is you've got to perform the due diligence. And there's two different types of due diligence. There's the financial due diligence, and then there's the property due diligence, or physical due diligence, which we'll talk about in a minute. Okay? So the financial due diligence is you're going to go through the financial statements for the property. You're going to go through the utility bills, the taxes, tax bills, insurance bills, you know, property management fees. You're going to evaluate that. You're going to review all the leases. You're going to review the budget for the capital expenditures that you're going to make for the fix-up. By the way, your renovation is called CapEx, capital expenditures. Okay, that's just another nomenclature thing. So you're going to evaluate all these things. Now, if you're doing a larger property management companies will help you with all of this. Okay, that's one of the services that they do. But then you're going to do the physical due diligence, right? You're going to, and again, I told you about that tool book. I showed you that tool book. Get that. That'll help you with all this, okay? Again, you just text ROD to 72345. All right, so the physical due diligence, you're going to check the property out, right? Now, I'm going to recommend that you video and take pictures inside every unit, okay? And so what we do is we have two people, one person with the camera, one person with the video camera. They take a picture or video of the unit number, and then everything behind that is that unit. And that may be the only time you're in that unit for a long time, but you check every single unit, okay? Then if the property has any inkling of an issue, you have a building inspector come and help you with the building inspection. I do it almost every single time, even though I could probably be a general contractor, but I want another set of eyes on there. You're also always going to get a phase 1 environmental. The bank will require it. And what that is to make sure that there's no environmental issues in the soil, like maybe there was a dry cleaner there previously or a gas station. Now, this is important. Always, always, always get one of these, okay? Because even if you're getting a seller finance deal and there's no bank and they're not requiring it, always get one. Because if there was a gas station or if there was a dry cleaner or some other toxic thing in the soil, the day after you buy it, guess who's responsible for it if it's there and the EPA finds it? You. Doesn't matter when it happened, okay? So always get one of these. It's a very cheap insurance. If there's any potential structural issue, get a structural engineer out there to look at it. Have vendors come. Have the have the sewer line scoped. Especially if you've got big trees. Make sure they're not collapsed, so they'll run a camera through the sewer lines. Have the AC looked at, have the plumbing looked at, the electrical. If there's any question whatsoever, you have vendors out there to check it out, right? Very important. Then you've got the legal due diligence that you're going to go through, okay? The title work, making sure the title's clear. The bank will do this as well, and your attorney will do this. The survey, making sure there's no encroachments. That here's the land for the apartment complex, and the neighbor hasn't built something on the land, right? That's called an encroachment. So you want to make sure that's what the survey's for. You're going to get title insurance to make sure the title is clear. You're going to have the contract, of course, is always going to be reviewed. And so you're always going to have that, again, either created by an attorney or reviewed by an attorney. Okay, if you find an issue in your due diligence, okay, let's say something was misrepresented or something wasn't disclosed, or maybe the owner didn't even know about a big issue. You have three options. One, you can do nothing, especially if the issue is minor. You do not want to be known for renegotiating, okay? But that's the next thing, is you renegotiate. And in the business, it's called retrading, okay? And that's the second option that you can do. And then the third option is you can walk away. And I will tell you, sometimes the best deal is the one you walk away from, right? So very important. Do not be afraid to walk away. Very important. Do not get caught up in the excitement of a deal and do a deal you shouldn't do. So those are your three options. But again, don't be known as the person that renegotiates everything, because you want to have a good relationship with brokers, because they can make you wealthy. But if they know you renegotiate all the time, you'll never get a deal from them. Okay, so you're ready to close. You use checklists, okay? And we provide this stuff at my boot camp, but you're going to want to make sure you get your hands on some checklists so that you make sure all the pre-closing tasks are done. You've got to... You're going to finalize your rehab budget with contractors to make sure it's accurate. You lock in the interest rate with the bank. You get a commitment letter from the lender. By the way, these are negotiable. Okay, these commitment letters. If you're not happy with something, you can negotiate those to some degree. You're going to have an attorney review the settlement statements. This is all a pre-closing checklist, right? And then after closing, there's some things you're going to do. You're going to update it. If the property's got a website, you're going to update it or build your own. You're going to pay all the fees associated with the closing, the legal fees, the appraisal, the inspections, things like that. You're going to bind the insurance for the property. You're going to hire a management company. They should already be involved at that point, have inspected the deal. You're going to schedule your renovations. You're going to get rocking on those. You're going to introduce yourself somehow to the residents with a letter, or the property management company to introduce themselves. You're going to open bank accounts. So all this stuff is post-closing, right? Now, let's talk about some overarching things here. Number one is you don't dabble. Dabblers get crushed, okay? You need to learn the business. Now again, I do these boot camps. If you text multifamily to 72345, we'll tell you about my next boot camp. And I don't sell anything at these boot camps. They're 18 hours total training. It's drinking through a fire hose, I'm going to tell you that. I've never had a complaint, other than the breaks are too short. I do 15-minute breaks because I'm trying to pack so much stuff in. But if you want to, you could also go to multifamilyvirtualbootcamp.com. There'll probably be a link below here as well. But don't dabble in this business. Learn the business, okay? And by the way, my boot camp's usually around $100, $150. That's it, okay? So it's a no-brainer if you can make it, truly. You'll be glad you came, I promise. This business is a team sport. You don't do this by yourself. You want to align with other people. So go to your local meetups or real estate investor club meetings. Meet other people in this business. This truly is a team sport, because most, like my Warrior Mentorship Program, my coaching students, there's hundreds of them around the country. And I told you there's somewhere between 40,000, 50,000 units owned now, and I've only been teaching 3.5 years, but almost all those deals were done between warriors. Okay, people, because you want to play to your strengths. If you're the analytical person, you align with somebody that's the outgoing person, or vice versa, and then you just go crush it because you're playing to your strengths. So it's a team sport. So you'll partner with other investors, coaches like myself or someone else, mentors, bankers, operators, brokers. You're going to partner with these people to make things happen. You're going to be persistent. Don't get frustrated. We're in a hot market right now. But again, markets go through cycles. Trust me, it won't always be hot. But if you're learning this business now, if it cycles down, you're going to have an exponential opportunity, because there will be exponential opportunities. And it's not if, when. It's a when thing, not an if. It's just the way, it's like life. It's like the seasons of weather. Real estate goes through seasons, and we have been in summer for a long time. So it's coming at some point. Be persistent. Don't give up. Stay focused. Be disciplined, which is, if you listen to my podcast, you'll see I spend a lot of time on mindset, because 80 to 90% of your success in anything is your mindset and your psychology. Only 10 to 20% is this stuff we're going through here. You got to actually take action with what you learn. You got to push through fear. You got to push through limiting beliefs. Maybe you're comfortable. The comfort zone's a warm place, but nothing freaking grows there, right? You got to get uncomfortable to build that life that you want. You got to be disciplined and organized, and you got to study this business, okay? So if you want to contact me, again, my boot camp, you text multifamily to 72345 or go to multifamilyvirtualbootcamp.com. I'm all over social media. It's Rod Khleif, and I'm very responsive. If you DM me, you will get a response. And I'm on YouTube. I write articles for Forbes. You'll see those around. So listen, I'm just trying to start a relationship with you. Follow me on Facebook or on Instagram or subscribe here on YouTube, and you'll get tons of great information. My goal is to add as much value to you as I possibly can, and this is the way the world works. What you give, you receive, and I'm super blessed because I'm trying to give all the time. And so anyway, it's my pleasure to meet you. Thanks for watching, and I'll see you soon.